Hello, today is January 28th, 2026. Everyone is lying to you about today. Turn on the TV, and they are celebrating. They are popping champagne because the S&P 500 hit a new all-time high of 6,978. They are telling you this is the golden age. They are telling you the bull market is unstoppable. But if you look at your actual purchasing power, you didn't get richer today. You got devalued. While the stock market made a new high, the United States dollar index collapsed to a 4-year low. While the algorithm bought stocks, the smartest money in the room, the central banks, panic bought gold at $5,180 an ounce. This isn't a bull market. This is a currency crisis wearing a Gucci belt. This is the pre-market pulse. What breaks next? First, let's look at the seduction. Why is the retail investor all in? Because the AI narrative just got a massive hardware upgrade. For 2 years, the market only cared about chips. NVIDIA, AMD. Today, the market realized you can't run chips without plumbing. Corning, GLW, surged 12% today. Why? Because they just signed a $6 billion deal with Meta to provide the optical fiber for their data centers. Cloudflare, net, jumped 19%. Why? Because a viral AI agent called Claudebot proved that the future of AI isn't just making the model, it's securing the traffic. F5 Networks is breaking out because the hybrid cloud needs load balancing. The crowd believes we are in a no-landing scenario. They see 4.4% GDP growth and believe the Fed has pulled off a miracle. They think the only risk is not owning enough tech. That is a comforting story. It is also a trap. If this economy is so robust, explain to me why the single most important sector for the American middle class, healthcare, just got decapitated. Contradiction number 1, the United Health disaster. While you were watching the S&P 500, the Dow Jones' biggest component, United Health Group, crashed 20% in a single session. Humana, down 21%. CVS, down 10%. Why? Because the government gravy train just stopped. The new administration proposed a Medicare Advantage rate hike of essentially 0 to 0.09% versus the 4% the market expected. The market is pricing in infinite growth for tech, but structural collapse for the safety net. You cannot have a healthy bull market when the healthcare sector is being liquidated. Contradiction number 2. The consumer is terrified. Stock prices are at record highs. But consumer confidence just swooned to 84.5. That is the lowest reading in over a decade. Think about that. The consumer feels worse today than they did during the pandemic lockdowns. Why? Because they live in the real economy, not the financial economy. They see what you see. Inflation is sticky and jobs are getting cut. UPS just announced 30,000 job cuts today to unwind their Amazon partnership. The stock market says party. The consumer says panic. History tells us the consumer is right. But the biggest lie of the day is about your money itself. Usually, when the economy grows at 4%, the currency gets strong. Investors flood in to buy dollars. Today, they are fleeing the dollar. The dollar index is at a 4-year low. And here is the scary part. The president is cheering it on. When asked about the crash in the dollar today, President Trump said, "I think it's great. The dollar's doing great." This is a regime change. The administration has explicitly greenlit the devaluation of your capital to juice exports. This explains gold. Gold didn't just drift up. It went parabolic to $5,180 an ounce. Silver is over $110. Investors are buying stocks to chase growth, but they are buying gold to survive the currency debasement. As one former banker noted in the data today, central banks don't trust their own money anymore. When you see stocks and gold hitting record highs simultaneously, it means the denominator, the dollar, is breaking. So, how do you trade a market that is fundamentally broken but nominally rising? You have to play by the new rules of Trade War 2.0. Yesterday, the rules changed. The president announced 25% tariffs on South Korea, autos, lumber, pharmaceuticals. If you own Hyundai, Kia, or suppliers dependent on Korean manufacturing, you're in crosshairs. But notice the pivot. While he hammered Korea, a U.S.-India trade deal was confirmed. This is the new playbook. Friends get access, competitors get tariffs. Who wins? Williams-Sonoma, WSM. Jeffries pointed out today that WSM imports 15% of its goods from India. A trade deal slashes their tariff rate from 29% to 22%. Stop buying emerging markets ETFs. You have to pick the winners. Long India beneficiaries, short Korea exposure. Finally, we need to talk about volatility. Because the dollar is weak, every physical shock gets amplified. Look at energy. A massive freeze on the Gulf Coast just knocked out 15% of U.S. oil production overnight. Exports dropped to zero on Sunday. In a strong dollar world, that's a blip. In a weak dollar world, that is an immediate tax on the consumer at the gas pump. And watch the bond market. The 10-year yield crept up to 4.23% today. The bond market is sniffing out the inflation that comes from a crashing currency. If yields spike, if the bond vigilantes reject this 4-year low dollar, the valuation math for those AI stocks you love collapses. Microsoft, Apple, and Tesla are reporting this week. They need perfect execution. If rates rise, perfect isn't good enough. The takeaway: the market is mispricing the safety of a U.S. dollar. We are in a crack-up boom. Nominal prices rise, but real value stagnates. 1. Avoid the insurers, UNH, HUM, the government bid is gone. 2. Buy the AI plumbers, GLWnet. The infrastructure build is real. 3. Respect the gold price, $5,180. It is the only honest signal on the board. Don't confuse a bull market with currency devaluation. This is the pre-market pulse. Stay sharp and trade safe. Finally, liquidity becomes a trap. We are seeing sell America flows. Money is moving into gold, silver, and foreign assets. If that rotation accelerates, the bid under the S&P 500 vanishes faster than you expect. You are left holding paper that is optically expensive and fundamentally devalued.